In the scorching heat of the summer of 2006 to 2012, do you know what was hotter? The U.S. housing crash, and it was right in the middle of a recession. And now, in 2023, for the first time since the Great Depression, the housing market is headed towards its worst decline. And just like the world held its breath during the housing market crash in the 2000s, little attention was and is being paid to the years leading up to the plunge, the bubble era. Is the housing market on the verge of a crush? Will the stock market crash too? What is Warren Buffett's investment strategy in the midst of all of this? Will this financial whirlwind reshape the planet? We'll be answering your questions in a minute, but first, hit that subscribe button for easy access to more valuable financial info like this. First off, what is a housing bubble? A housing bubble, also known as a real estate bubble, is the term used when housing prices skyrocket due to soaring demand, rampant speculation, and unchecked spending, eventually leading to a dramatic collapse. The bubble typically begins with a surge in demand, often against a backdrop of limited housing supply that takes a considerable time to replenish and expand. As speculators pour money into the market, demand intensifies further. However, a tipping point is reached where demand declines just as the housing supply experiences an uprise, resulting in a sudden and steep fall in prices, the inevitable burst of the bubble. That's where we are right now, on the verge of a burst. At this point, all that's left is speculation, investment, and greed. Thanks to average mortgage rates staying steady at more than twice their 2020 and 2021 levels, and housing prices remaining exceptionally high, the housing market crash is showing little activity. Existing home sales have hit their lowest point since the foreclosure crisis peak in 2010, and mortgage demand has plummeted to levels not witnessed in over 2 decades. Adding to the economic uncertainty, household debt, fueled by mortgages, credit cards, and student loans, has surpassed $17 trillion. Additionally, inflation persists above the Federal Reserve's 2% target rate, and there's a looming possibility of a recession in 2024. If you find this insightful, give us some encouragement by hitting that subscribe button over there. It goes a long way. Now, here's the big question. Is the housing market on the verge of a crash? During the 2006 Berkshire Annual Meeting, Warren Buffett and his late partner Charlie Munger were questioned about residential real estate and whether he believed it was in a bubble. His response is remarkably similar to the current scenario across the United States. Warren not only highlighted the risks, but also accurately identified that regular individuals aren't the culprits. It's the speculative real estate investors employing excessive leverage and greed. Let's listen to what he had to say. This deadly combination, as he correctly foresaw, is poised to result in an implosion. From time to time, even in great localities like New York, we've witnessed significant fluctuations in property values. The real estate brokerage business across multiple states reflects a slowdown everywhere, particularly in the once hottest markets. According to Warren, the high-end market and areas where speculation and investment are rampant are prone to the most significant fall-off. He emphasizes the role of investors who treat the housing market crash like a stock market crash, utilizing leverage and engaging in flips similar to day trading. Looking at recent data, investor activity has surged to unprecedented levels in the last 2 years, with many resorting to speculative funding methods, risky loans, and fraudulent practices. As Warren notes, the real estate market exemplifies the law of the vital few, where a small number of transactions can significantly impact property values. The precarious nature of this market, driven by housing investment patterns, raises concerns about potential rapid downturns and crashes reminiscent of the 2008 recession. The root cause of all this is the imprudent lending practices to overly ambitious individuals. Before the last crash, numerous individuals, not just this individual you often see in Hollywood movies, were warning about the imminent doom for the housing market. Contrary to popular belief, both prominent investors and regular folks were well aware that the market was in a massive bubble ready to burst. Warren Buffett expressed his concerns during the 2006 Berkshire Annual Meeting, which was very close to the peak of the last bubble. This slowdown is most dramatic in markets that were once the hottest. The markets where you're likely to see the greatest fall-off are the high-end ones, where the biggest bubble tends to be. These are areas where people buy for investment or speculation, rather than for personal use. In effect, It's like day traders of the internet moving into the day trading of condos. This leads to a market that can move significantly. It first stops, then reopens, creating a big shift. Recent data from the National Association of Realtors doesn't rule out the possibility of a housing market crash. In August, existing home sales hit their lowest point since the beginning of the year. Mortgage interest rates, reaching 7.31% last week, are now at their highest since 2000. Despite these factors, the average U.S. home price remains notably high at $495,100. Although it's a decrease from last year's record of $552,600, it's still more than double the average price of $212,100 from the year 2000. The combination of elevated interest rates and soaring home prices is considered abnormal. Historically, home builders thrive in environments with falling interest rates. This situation raises concerns, suggesting a potential housing market crash in 2024. So yeah, millions of people will be blindsided in 2024. Will you be one of them? So far, if you've gained so much from this video, hit the subscribe button to join our quest for financial intelligence. Now, back in the mid-2000s, the US faced a housing bubble which led to the infamous housing market crash, and it had a connection to another bubble in the technology sector. This tech bubble, often referred to as the dot-com bubble in the late 1990s, saw the stock prices of many new tech companies soaring to extremely high levels in a short time, even for startups without actual earnings. So smart investors who were into stock investing were expecting a stock market crash. Just as expected, when the Nasdaq peaked in 2000 and the tech bubble burst, the stocks that were flying high came crashing down. Following the dot-com bubble burst and a stock market crash, investors shifted their money from stock investing to housing investing. Around the same time, the U.S. Federal Reserve lowered interest rates to counter the mild recession after the tech bust and to ease uncertainty stemming from the World Trade Center attack on September 11, 2001. This move further fueled the housing market and contributed to the infamous financial crisis of 2007-2008. In the grand scheme, all these behaviors resembling bubbles with significant price increases often led to a crash. Warren Buffett and Charlie Munger addressed similar lending situations at a Berkshire conference, highlighting the consequences of dumb lending practices. Trends in stock investing and housing investing could cause a stock market crash or housing market crash, which tends to have severe repercussions but may not become apparent immediately, comparing it to a disease that takes time to manifest. Buffett and Munger emphasized that dumb lending, seen in commercial financing in the 80s and other crises, involves developers taking advantage of available money, leading to the construction of projects that might not be sustainable. There's a high tendency for lending institutions to pour money into anything, contributing to a cycle of risky projects and potential crises. So it's basically a repeat of history, although there are a few variations. How does today's housing market differ from the 2008 housing crash? One notable distinction is that lending standards are now stricter, a response to lessons learned and new regulations post-2008. This means those approved for mortgages today are less likely to default than pre-crisis approvals. Leading up to the Great Recession, the housing market relied on rapid credit expansion and optimistic expectations for house price growth, which proved unsustainable. Unlike in the past, where adjustable-rate mortgages, ARMs, were common, most borrowers today have fixed-rate mortgages. Even though mortgage rates have increased, current homeowners with fixed-rate mortgages experience no change in their monthly payments. In terms of equity, more homeowners today have equity in their homes compared to the 2008 crisis. Nearly half of mortgaged homes in the U.S. are considered equity-rich, with loan balances at or below 50% of the property value. This contrasts with the 2009 scenario, where a quarter of homeowners were underwater, owing more than their homes were worth. While equity saw a slight decline in Q2 2023, homeowners' net worth has grown, with a typical homeowner gaining over $100,000 in net worth since 2019. Despite fluctuations, home equity remains robust, contributing to the overall stability of today's housing market. We are having a repeat of history, Significant price variations are being driven by risky loans that promote speculative real estate investors across different locations. There's going to be a significant housing market crash from this lofty top. Housing crashes, just like stock market crashes, occur suddenly rather than steadily. Throughout the turbulent voyage, the market might be difficult and unpredictable. There's a greater chance of a sharp collapse on the other side with larger gains. Want to get more insight into how to build your financial capacity? Watch this video displaying on the screen.